Hello and welcome to the Week in Markets. I'm joined by Sam Elliot, investment analyst, and we're going to talk about the key events of this week and how markets have responded to those events. I suppose coming into the week, looking at the economic calendar, it was pretty quiet, and really markets had got off to a reasonable start, building on the good news that the big beautiful bill from Donald Trump was signed on Friday, so that would extend the current tax rate beyond this year, but also provided tax relief on tips and on overtime. So a bit of positive sentiment, but tariffs have started to flare up, Sam. Can you talk about just the developments that we have seen there this week?
Yeah, sure. Thanks, Paul. So think back to April. We had the news of tariffs being delayed by 3 months. That deadline was this week, so it was set to expire on Wednesday this week. We've had news actually that's been extended further, so that 90-day pause extended to the 1st of August. But actually, tariffs have been back in focus, as you say. Trump's been taking aim particularly at commodities. So we've had copper in focus, a 50% tariff or tax imposed on imports of copper to the US. Also been looking at things like pharmaceuticals, not imposed, but a warning of a 200% tariff on pharmaceuticals. Then also from a country perspective as well, he's been looking at Brazil. He was talking about them attacking free speech, a 50% tariff rate imposed on Brazil starting on the 1st of August. And also Canada as well, so the US's second biggest trade partner last year, 35% tariff rate there, starting on the 1st of August as well.
So definitely the rhetoric has been building throughout the course of the week, and he's targeting various countries individually and commodities, as you discussed. If we look at commodity prices, I think we're up about 10% last time I looked so far this week. We've seen some weakness coming through in Brazil and also in Canada in the currency and in the equity markets. But how would you characterise how general equities have been performing, and have they been resilient to this news?
Absolutely. So it seems like equity markets have just looked through the news, really. Investors maybe being a little bit desensitized to the news coming out this week. So equity markets are really pushed on, particularly here in the UK. The UK index is quite mining focused. So those companies have benefited from those higher commodity prices. We've seen actually the UK equity market reach new all-time highs on Thursday of this week as well. And that's in spite of currency strength. So we've seen the pound strengthen through the course of this year. Normally you would think that is a bit of a negative for the UK market, just given the export nature, but actually UK equities have pushed on, reached all-time highs. Also in the US, not quite reaching all-time highs, but there or thereabouts at the end of Thursday as well.
Interesting. I think it is interesting that equity markets are continuing to look through the tariff announcements, perhaps just believing that Trump always chickens out, and when we get to the 1st of August, he might extend again. And what's really important for companies will be the earnings that they report. So that kicks off next week with the US banking companies. So that's going to be really critical to look out for. And not only the results that they deliver or report for the second quarter, but what the CEOs are saying around tariffs, how they're dealing with tariffs, and what effect they're having on demand and, importantly, on their profit margin. So we'll keep you up to speed on that next week. You mentioned UK equities, a real positive, up to a new all-time high. Certainly an area that some of our managers at True Potential have been leaning into more so over the last few months. I suppose we've had a little bit of news around the UK economy today actually on the GDP front. The first quarter of this year was actually quite strong, I think, up about 0.5%, which was higher than expected. Q2, is it more of the same?
It's actually a bit more disappointing, Paul. So for the second month in a row, we had the May data released today. For the second month in a row, the UK economy contracted. So it fell by 0.1%. Expectations were for a rise of about that much.
Right.
And we saw, in terms of areas, it was the likes of industrials, it was the likes of construction as well, where output was falling. As you say, Q1 was strong. maybe a lot of that driven by exports ahead of potential tariffs being introduced. And that's come out in the wash in Q2. So those areas such as construction fall in Q2. One positive area continues to be services. That was in spite of retail fall, and the services sector continued to contribute positively.
I think it's important that it's the services actually that's the largest component of the UK economy, like it is in the US. So we are seeing some strength, but I suppose disappointing that growth appears to be cooling, and it looks like the UK economy is not going to meet the Bank of England's forecast for Q2, which I suppose in terms of interest rates, what would you expect then?
Well, if you look at market expectations, it continues to be for a further 2 interest rate cuts for the rest of the year. So that would be the interest rate coming down by 0.5% for the rest of the year. And I guess the weaker growth data in the UK is just supporting the view that those cuts will come through.
Yeah, very good. So equities all-time high. Momentum may continue depending on what happens on the tariff front as we get close to the 1st of August. But critically, it'll be the earnings next week and the week after that will really be important for prices. And thinking about the UK, looks like Bank of England's got scope to cut interest rates over the next few months, given the weaker growth, and that inflation actually is trending a little bit better. That's all from us today. Thank you, Sam, and thank you for joining us. We'll see you next week.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.